Are you unsure what the differences are between the TFSA, the RRSP, and the FHSA? Or maybe you're confused about which of these three accounts you should invest your money in. If so, keep watching to find out which one is best for you. Hi. My name is Kat and I'm a chartered professional accountant. On this channel, we discuss Canadian tax, accounting, and personal finance, with the goal of helping you keep more of your hard-earned money in your own pockets. Today's video is all about comparing the TFSA with the RRSP and the FHSA. We'll go over the 4 key characteristics of each, including their goals, criteria for opening the account, as well as how contributions and withdrawals work. We'll also discuss 7 important factors that you should take into consideration when deciding which one to contribute to. At the end of the video, I'm going to share a free tool to help you determine which of these accounts you should prioritize investing your money in. So let's jump right in. Before going over the 4 characteristics that differentiate the TFSA, RRSP, and FHSA, it's important to mention that they all have one very valuable benefit in common. That is, the money you earn within each of these accounts is completely tax-free. This means that whether we're talking about the TFSA, the RRSP, or the FHSA, any interest, dividends, and capital gains earned inside the account is not taxable. Alright, so let's start with the goal behind each of these accounts. The goal of the TFSA is to simply save money tax-free. The goal of the RRSP is to put money aside for retirement. The goal of the FHSA is to save money for a down payment on a home. The type of account you should contribute to will therefore depend partially on what your personal goals are. For example, if you want to save for retirement and won't need the money anytime soon, investing in the RRSP is likely to be the best option. Second, although you must be a Canadian resident in all 3 cases, the rest of the criteria for opening either one of these accounts is different. For the TFSA, you must be at least 18 years old to open an account. For the RRSP, you have to have what we call earned income and file taxes in Canada. The 3 most common types of earned income are employment income from your job, income from your self-employed business, and rental income from any real estate property you own. Finally, for the FHSA, you must be aged between 18 and 71 years old. And you must be a first-time home buyer. In simple terms, a first-time home buyer is someone who hasn't lived in a house, owned by themselves or their partner, in the last 5 years. Most Canadian residents meet the criteria for opening a TFSA or an RRSP, but not everyone can open an FHSA. Now let's move on to contributions. The amount of money you can contribute to each of the accounts is different. Everyone gets the same maximum contribution room every year for the TFSA and the FHSA. The annual TFSA dollar limit was $5,000 in 2009 and has increased to $7,000 in 2024. If you were 18 years old in 2009 and you never contributed to a TFSA, your limit in 2024 would be $95,000. The annual limit for the FHSA is $8,000, up to a lifetime limit of $40,000. For the RRSP, the limit is based on 18% of your earned income from the previous year, up to an annual maximum amount. Any unused contribution room for each of these accounts can be carried forward to a future year. However, for the FHSA, the carry-forward amount is maxed at $8,000. The annual contribution deadline for each of the accounts is December 31st, except for the RRSP, where the deadline is 60 days after the end of the year. Last point about contributions: the amount you contribute to your RRSP and your FHSA is tax deductible. That means that it reduces your income for the year, which results in you having less taxes to pay. We'll look at an example a little later to see how that works. On the other hand, contributions to your TFSA are not tax deductible. Moreover, if you've already made a qualifying withdrawal from your FHSA, any new contributions are no longer tax deductible. Finally, let's talk about withdrawals. You can withdraw the money from your TFSA, tax-free at any time, for any reason. Any amounts withdrawn get added back to your contribution room for the following year. For the FHSA, withdrawals are also tax-free, as long as you meet all of the required criteria. I go over what the criteria are in my video all about the FHSA, linked in the description box below. As for the RRSP, withdrawals are not tax-free, except under the Home Buyers Plan or the Lifelong Learning Plan. This means that any money you take out of your RRSP will be added to your income and taxed at your marginal tax rate. Moreover, you don't get your contribution room back when you withdraw money from your RRSP. Now that we've gone over the main characteristics of each type of account, let's discuss 7 important factors that you should take into consideration when deciding which one to contribute to. Before we go on, if you've learned something so far, please take a second to give this video a like, it really helps the channel. Number 1, do you qualify as a first-time home buyer? This basically means that you didn't live in a home owned by yourself or your partner in the current year, nor in the previous 4 years. If you qualify as a first-time home buyer, you're one of the lucky people who is able to open the FHSA and enjoy its benefits. Even if you don't have plans to buy a home, it's worth opening an FHSA. You can leave your money in the account for up to 15 years, which is plenty of time to earn tax-free investment income. Then, if you never end up buying a home, you simply transfer the funds to your RRSP without affecting your contribution room. It's basically an extra $40,000 of RRSP contribution room that you wouldn't have otherwise. Number 2, do you expect to need the money in the short term or in the long term? Given the restrictions around withdrawals, the FHSA and RRSP are better for long-term investments. The TFSA is more flexible, as it allows you to withdraw the funds anytime and you get your contribution room back. So, if you think you'll be needing the money in the short term, the TFSA is the better option. Number 3, how much is your annual earned income right now? If you have a high annual income, the FHSA and RRSP are more advantageous because your contributions are tax deductible, which means you pay less taxes today. If your income is on the lower side, you may want to consider investing in the TFSA first and keeping your FHSA or RRSP contribution room for later, when your income will be higher. Let's look at an example to see how contributions impact your taxes. Let's say your income for the year is $140,000, and you make a $10,000 contribution to your RRSP. This brings your net income down to $130,000. Your taxes without making the contribution would have been almost $25,000. But, with the $10,000 contribution, they're reduced to just over $22,000. Your RRSP contribution saved you $2,600 in taxes, or 26% of your $10,000. On the other hand, if your annual income is lower, let's say $50,000, and you make the same $10,000 contribution, your net income will go down to $40,000, and your tax savings will only be $1,500, or 15% of your contribution. This is because you are in a lower tax bracket with a $50,000 income compared with a $140,000 income. In other words, the higher your tax bracket, the more taxes your RRSP and FHSA contributions will save you. Number 4, how much do you expect your annual income to be in the future? Similar to what we just discussed, if you think your income will be higher in the future, you'll want to consider keeping your FHSA and RRSP contribution room for later, so as to save more in taxes. That would imply prioritizing investing in your TFSA first. If on the other hand, you expect your future income to be lower than your current income, then you'll want to prioritize contributing to your FHSA and RRSP sooner rather than later. Number 5, do you currently have an emergency fund saved up? If you don't, you should consider saving up for an emergency fund before anything else. This is money that you'll need to have accessible for unexpected emergencies, such as your car breaking down or losing your job. It is generally recommended to have 3 to 6 months of income saved up for emergencies. Since you want to be able to access this money at any moment, it's a good idea to put it in a TFSA, since you can withdraw the funds whenever you need them. Number 6, does your employer offer an RRSP matching program? An RRSP matching program is when your employer matches your contributions to a group RRSP up to a certain amount, or up to a percentage of your salary. Let's say you put $1,000 in your group RRSP, and your employer matches that with a $1,000 contribution as well, for a total of $2,000. You basically just got $1,000 of free money. Not every employer offers this type of program, so if yours does, definitely take advantage of it by investing in your group RRSP before anything else. Finally, number 7, do you currently have any high-interest debt, such as a credit card? If you do, you should consider paying it off before investing in any registered account at all. The reason for this is that the interest you'll be paying on this debt is usually far greater than the return you'll be making on your investments in the TFSA, RRSP, or FHSA. Let's look at an example. Let's say you have a $5,000 credit card balance at 20% annual interest. That's $1,000 in interest charges for the year. And let's say you decide to invest $5,000 in your TFSA, instead of paying off your credit card. Now let's be generous and say that your return on investment in the TFSA is 10%. That means you'll have earned $500 in interest from your TFSA. So, $500 earned on your TFSA minus $1,000 paid on your credit card, you end up with a negative balance of $500. To avoid this, pay off high-interest debt before contributing to any of these registered accounts. Alright, so, if you're still unsure which of these 3 registered accounts to contribute to, I created a short quiz to help you decide. It's completely free, and all you need to do is answer 7 questions. The quiz will then tell you which account to prioritize between the FHSA, RRSP, or TFSA. Obviously, this doesn't replace sitting down one-on-one with a financial advisor who will go over your personal situation in detail. It's simply to help get you started. Just click the link in the description box below to take the quiz. And be sure to share your results in the comments once you're done. So there you have it. We discussed the 4 key characteristics of the TFSA, RRSP and FHSA, their goals, the criteria for opening the accounts, as well as how contributions and withdrawals work. We also discussed 7 important factors that you should take into consideration when deciding which one to contribute to. And I shared a free tool to help you determine which of these accounts you should prioritize contributing to. That's all for today's video. I hope you found the information helpful. Don't hesitate to ask your questions or submit special requests for future videos in the comments. Be sure to hit that notification bell if you want to be the first to know when a new video is released. Thanks for tuning in, and I'll see you next time.